Hello and welcome to the Stockout. I am one of your hosts, Mike Baudendistel, joined by Grace Sharkey. Today, I think we have a topic that's top of mind for the intended audience of the show, which is supply chain professionals, particularly those in the retail and CPG industry. We're going to be talking about the economy, tariffs, et cetera. So, Grace, you found our guest. Why don't you like to intro him, please?
I will also like to say it's St. Patrick's Day, Mike, and I noticed you don't have any green on, so I'll give you a quick pinch there for that. But yes, no, we do have a really exciting guest with us here for this wonderful St. Patrick's Day episode. We're hearing a lot from shippers, not only right on the editorial side, on the Sonar side, from customers as well, just in this state of confusion and on what's happening in the economy with, of course, the tariff war. And I thought it'd be really incredible if we could bring on an economist from an interesting perspective. So with us today is Dan North, the senior economist at Allianz Trade North America, which ensures B2B transactions, of course, visibility into payment behaviors as well for those that they cover, and including looking at credit risk and trade flows across North America as well. So Dan, thank you so much for joining us. I'd love if you could give us an economic breakdown of what you're seeing as well.
Okay, well, I think that what you hinted at was uncertainty and things changing so rapidly, and that is certainly the economic landscape. If we could bring up my slides, I think I'm gonna speak for about 20 minutes on the U.S. and the U.S. economy. But before I do, I want to tell you a little bit about us, Allianz Trade, so you get a better idea of where our thinking comes from. So if we go to the next slide, we'll see that there's a lot of numbers on this next slide. We are the world's largest provider of trade credit insurance, as it says there across the top. And the way it works, basically, if you're a business that sells goods and services on open account to other businesses, you send your goods and send an invoice that says pay me back in 30 or 60 or 90 days. And you run the risk that other business that you sold to will get into financial trouble and won't be able to pay you back. We protect you against that. We protect you against non-payment. And looking at the first row of numbers across there, we're in 52 countries around the world. We have 5,500 employees, 62,000 clients, lots of other numbers on that chart. But the one I like best is down in the lower left, 1,000 claims indemnified each week. Trade credit insurance is a discretionary purchase. It's not like auto insurance you have to drive. So we have to show our clients value. And we do that by paying claims. Every CEO that's I've ever worked under said we have to pay more claims. It's counterintuitive to an insurance company, but if we don't, we're not offering any value. So we have to have some idea of what's going on in the economy and the rate at which companies may run into financial trouble. And if we go to the next page, we'll have an idea of what we're going to be looking at, the administration's policy. And of course, the one right at the top is tariffs. And I put there the first bullet. It's a fluid and volatile situation because it literally changes overnight. But I'll read down the bullets, which is a dreary way to do a presentation, but I'll do it in this case. Tariffs are a bad idea economically. A trade war hurts both sides with increased inflation and potential job losses. There are few winners and many more losers. For example, and I'll show this on the next page, metal tariffs help producers. Let's go back one to, thanks. But hurt a lot of users. Tariffs on imports hurt U.S. consumers and businesses. Retaliatory tariffs hurt exporters and business. But they can be a good cudgel for negotiations. They're being leveraged on Canada and Mexico and even China. But in a severe trade war, where the U.S. increases tariffs on Chinese goods to 60% and from the rest of the world to 20%, and there's retaliation, global GDP growth could be cut by a third. A third. So this is a huge deal if we get into a real big trade war. And I note one thing there at the bottom because I cover the US and Canada and talk a little bit about Canada. Canada is the world's 10th largest GDP, and it's the third largest world's oil reserve. And it's the second largest importer into the US and the largest market for US exports. So it really is very important in the tariff situation. Now, on the next page, I'm going to show graphically across the top there, tariffs. There's no free lunch. And here's an example of metals tariffs from 2016. Users lose lots of jobs, producers gain a few. So over on the left, the map shows the share of county employment in steel and aluminum producing industries. And the map on the right shows the share of county employment steel and aluminum using industries. So you can see over there on the left, there are very few producers relatively, but over on the right, there are lots of users. So the tariffs are meant to benefit the producers, that few number on the left, and it's the users on the right that bear the cost. And that first line of text underneath, this has been tried before. In 2002, Bush imposed steel tariffs, and it temporarily created 3,500 jobs, but they cost 400,000 each, and it destroyed 200,000 other jobs. It's a loser. And then in the next line of text, the same thing happened in 2016 with the metals tariffs. There were manufacturing jobs created, but they cost $817,000. So it's kind of a losing game. Now, if we head to the next page, I'll talk about the other side of tariffs across the top there, inflation. There's no free lunch within tariffs. Free trade has resulted in some job losses, but consumers, where 70% of the economy, have enjoyed lower prices. Tariffs would reverse that. And what I mean by free trade and inflation is, if you look at that chart, the leftmost column covers the period of 1950 to 1973, where inflation was 2.7%. And then in the next column, we went through this very high period of very high inflation from 73 to 81. And in the next era, from 82 to NAFTA, is 3.9%. But then NAFTA kicked in, and inflation's been 2.2%. So this has benefited consumers, 70% of the economy. If we go to the next page, I'll show you another interesting fact about the U.S. Across the top, we're virtually the least dependent country in the world on exports. Mexico and Canada are heavily dependent on exports to the U.S. alone. And I've got some numbers there on that box over on the left. But there on the bottom row, you see United States is 183. That's 183rd out of 195 countries in terms of export dependence. We're we don't hardly rely on exports at all. The final column on the right shows that Mexico's exports to the U.S. alone account for 27% of all of Mexican activity. Same thing with Canada. 21% of GDP is exports to the U.S. The chart graphically shows it on the right. The bottom is circled there in red. That's each one of those bars is a country showing export dependence. We're just about the last one. So the other countries have a bit more to lose in terms of exports than we do. Now, so that's what's going on with tariffs. Let's take another look at a very important feature of the economy. We'll go to the next page, which is monetary policy. That is the Federal Reserve, which sets interest rates. And right now, they're facing the classic dilemma for a central bank. You risk either lowering interest rates, which could boost economic growth, but stoke inflation. Or you could raise rates, which choke off inflation, but slow economic growth. Got to have a balance here, and it's a tricky balance. Going to the next page, we'll look at the inflation part of this. And the trouble with inflation is it is cumulative. So the chart on the left starts back in 2021 when inflation really started to take off. Let's say a loaf of bread was $1, and the next day it was $1.10. The next day it was $1.20. It builds up over time. And that black line shows wages cumulatively have grown 19% since 2021, food 23%, shelter 24%, gasoline 34%. The chart shows that wage earners are still underwater. So for instance, we look at wages 19% and food 23%. That's a 4% difference. That doesn't sound like much, but it means that wage earners are still 4% poorer than they were before. They've lost ground. It's cumulative, and that's why things still feel so expensive. They are. Now, the most common measure of inflation is the chart in the middle. It's called the Consumer Price Index. And in this chart, the blue columns are the month-to-month changes, give you an idea of what's happening most recently. And you could see inflation's going up there. The black line is the year-over-year rate. You can see inflation's going up. They're backing up the wrong way. Now, the Fed's favorite measure over on the right is that blue line, PCE core. And you can see it's going the wrong way too. Now, if we go back to the in this chart to the left in time towards 2020, the blue line, inflation started going up, and the Fed's response is to raise that black line. That's the interest rate the Federal Reserve uses to control the economy. It's called the overnight Fed funds rate. And it raises that interest rate, and that slows down inflation and the economy. And you can see it worked, drove inflation down. And then last September, the Federal Reserve said, okay, we think we've got inflation under control. Let's get the Fed funds rate down to a more normal level. So you can see they started to cut the Fed funds rate. The black line went down. Well, this is the worst possible outcome for the Federal Reserve. They cut interest rates, and now inflation's coming back. This is the risk when you cut interest rates, that inflation will come back, and that is what's happened. On the next page, we'll talk about, so that's the inflation side. Let's look at the growth side. And on the next page, we'll look at, for instance, the labor market. That's the chart on the left. The columns are the number of jobs created every month, clearly going down. The unemployment rate, the black line, going up. The chart in the middle is two other measures of the labor market openings. The blue line down 20% year over year. Job quits down 15%. And that shows that people are no longer very confident that they're going to get a new job. So people are not quitting their jobs anymore. And finally, the chart on the right shows the net percentage of consumers who are now saying it's going to get worse in the next 6 months. There are going to be fewer job openings. So the labor market is deteriorating. The next page will show that the manufacturing sector is deteriorating. There's a chart there on the left. It's called industrial production. It's just a measure of everything that comes out of factory doors. That blue line, and you can see it's fallen very dramatically. It's now growing at 1% as opposed to the average of 3.1%. But you can see where I've got it circled there in red. There's a little turn up in January, and I'm pretty sure what that is companies front running the tariffs, starting to bring stuff in to produce to front run the tariffs. And we see the same thing in the chart on the right. These are new orders for durable goods like, washing machines and cars and airplanes. And you see the same pattern. It's come down dramatically, is very weak. But then that little blip in January. So that's manufacturing. Now let's look at the most important part of the economy on the next page, the consumer. Consumers are 70% of the economy. To consume, you need to have the willingness and the ability. The chart on the left is the willingness, and that's the consumer confidence. And it has taken a big drop recently. That's a 3-month drop there in that red circle. The ability is the chart in the middle. That's income. And you can see that's declining pretty seriously as well. And at 1.8% growth rate, well below the long-term average of 3.2%. And finally, the chart on the right shows actual spending. Look at that red column there. Last month, there was a big drop off in spending, 70% of economic activity. Now, let's go to the next chart, next page, and I'll kind of recap where we are. We see that growth is slowing a bit. We just saw that labor market, manufacturing, consumption. Also see inflation is still here. So this is the greater risk. So we think the Fed is going to be much more cautious about inflation, might cut interest rates one more time, maybe no more times, especially if these tariffs stay on. The tariffs are inflationary. And does it matter if the Fed cuts rate? Yes, it matters a lot. Interest rates are heavily influence the economy. Lower rates, stronger economy, but more inflation, and vice versa. So that's why we watch the Fed so carefully. On Wednesday, the Federal Reserve is going to come out and they're not going to touch interest rates. But the most interesting part is what they're going to say about it. I think they're going to say, we're not in any hurry to cut anymore. So that's what we're thinking at the moment. So we see that tariffs are inflationary. There are lots of losers and few winners. We see that inflation is still with us by several measures. We see the economy is slowing down. So there's this trade-off. And we think the Fed's going to be more interested in keeping inflation at bay. So they're not going to lower interest rates, which is going to be more of a drag on economy. So that's what we have there at the conclusions. We see tariffs and counter tariffs are going to raise inflation. The Fed is walking this fine line. That's why I expect one cut, probably none, really. The first half of 2025, we'll see zero GDP growth. And that's because of front running again. Net exports are hugely negative. They, in the calculation, are a drag on GDP. And net exports, again, were as a result of front running. We imported a lot of stuff to beat the tariffs. So that's I'm thinking on the U.S. Economy. Certainly, thank you for your attention. And we can go to Q&A now.
Yeah, so I have a few questions here for you. One aspect you literally just touched on, right, is the growth here in the first half of 25. Where do you see first quarter GDP hitting here in the next 15 days or so? How do you see the first quarter turning out?
Well, the trick here is we know we've already seen the data that's net exports. Again, really showing this front running of importing goods and services before the tariffs. So what you do is you strip that out. GDP is our broadest measure of the economy. It measures everything. If you think of the economy as one big factory, GDP is everything that comes out of that factory door. So if we want to get a measure of the health of the economy, let's strip out that net exports and look at just what's happening in the domestic economy. And that should be give us some moderate growth there. So we know it's going to be negative, but you got to know why. And it's not necessarily a terrible thing. We think the domestic economy is going to keep growing.
Interesting.
Yeah, I wanted to ask you, what do you think has surprised the stock market the most over the past 3 weeks? Like we knew that when Trump got elected, Trump equals tariffs, but what caused the psychology in the stock market to change so dramatically here?
Well, I think that it's the fact that situation changes so rapidly. There's always a saying that markets and economies don't like uncertainty. They can deal with bad news, but not with uncertainty. It's a overused expression. However, this level of uncertainty I would call, uh, you know, uh, so highly unusual, pioneering even. No one's seen this level of certainty. When you have tariffs are changing overnight, then that really contributes to weakness in both the economy and in the markets.
One thing I've, over the weekend, just catching up with news and everything as well, the term stagflation keeps coming up. But what are your thoughts on that aspect of what we're already seeing, right? What potentially, I mean, again, we are in a unique situation. We really don't know what might happen 2 hours from now, but stagflation wise, what's your perspective on that?
Okay, so first, there's the question of, are we going to go in a recession? And that, again, is negative GDP growth for 2 quarters in a row. That's sort of the definition. Stagflation has really only happened once, and it happened in the 70s, where we had the really grim combination of high inflation and very low growth, or even negative GDP growth. I think it's pretty early to say that we're going to have that, because it came from a very big shock, which was those 2 energy crises, which, by comparison, the tariff situation being fluid and changeable and so forth was nothing like those energy crises. I don't know if you remember that, but that was a very, very bad time. And that was the big contributor to stagflation. We still see growth, so that's the stag part. We don't see the economy not being stagnant. Inflation, to me, is more of a worry. We do see hints of inflation. Not out of control. It's all below 3%, which is pretty good historically. It worries me that it's creeping up the wrong way. I don't see stagflation coming about. It's a very unusual situation.
Interesting.
Well, that's good at least. So a lot of these things, I mean, you really lay out a lot of the concerns in the economy. I mean, how does that translate into your investment portfolio at Allianz? Is this more defensive securities and those things?
Well, at Allianz, our business is very short-term insurance. So we have very little risk in our portfolio. It's almost all cash or short-term treasuries. There's no equities in our portfolio at Allianz Trade. But if we want to talk about investing in different markets, the stock market, for instance, I get asked that a lot, what's happening in the stock market. And the truthful answer is, I don't know. And nobody else knows either. And I've learned this because I worked in investment research. You know that over the long term, stocks are going to go up. That's the way it's always worked, with sometimes some pretty big dips. But you can't tell when those are going to be. In other words, you can't time the market. So, for instance, a lot of people might think now, oh gosh, this is a really uncertain time. I think I should be out of the market. Well, if you think that you should sell now, you're almost certainly going to lose, because what will happen is you're going to sell at the bottom and you're going to buy at the top. There's a study that shows if you miss the best 10 days over a 20-year period because you blew timing in the market, just 10 days, you missed those out of the 20 years, your return over that period gets cut in half because the big returns happen on just a few days. So you can't be out of the market when those days happen, and you don't know when that's going to happen. So over the next couple of weeks, couple months, even this year, pretty hard to say. So that's why you have to stick in it for the long term, unless you're getting close enough to retirement that you want to start taking stuff off the table. But do you want to ask me what the stock market's going to do? Nobody knows.
So what you're telling me, Dan, is just don't look at my 401k for a while now and just breathe through it. Yeah, sounds good.
Yep, that's right, because you'll look at it and go, oh my gosh, I'm losing my nest egg here. And you'll make the classic investor mistake, which I know has happened to a lot of my friends the last time we had a big dip down. It's called capitulation. Finally give in. Everybody gives in at once, and that's when the market bottoms and you've blown it. So, you've got to avoid that selling at the bottom, and you don't know when the bottom is, and you're going to miss it. So, you got to stick in it for the long term. So unless you're right next to retirement, no, don't look, because that temptation will come up.
Just woosah, breathe through it then. Sounds good. Dan, running out of time here, where can people go to learn more about the work that you're doing and reach out to the company as well?
We're at allianztrade.com, and we're on social. We are on LinkedIn and Facebook and what used to be called Twitter. And we have a number of resources on our homepage, Allianz Trade. You can find a lot of my research there and a lot more information about how trade credit insurance really works.
Awesome. Well, Dan, thank you so much. Thank you to your team as well. And for our audience, of course, I want to remind you that we have a wonderful community here at the Stockout, which includes a weekly newsletter as well, where our wonderful Mike Baudendistel breaks down the economy and, of course, things that we're seeing here and at FreightWaves and Sonar as well. So make sure you head to the top of FreightWaves.com and you can click on the Stockout. And also join Fraud Watch, too, while you're at it. One of our biggest stories on the site today is a little bit of a stolen load situation for one of the big players out there. So we're already starting off the week with some wonderful fraud updates too. Of course, with that fraud newsletter too, remember that we'll be in Dallas, Texas here in May for our first fraud event. So make sure that you guys go check out live.freightwaves.com, not just for the fraud event, but of course we have a number of wonderful virtual events coming up soon. I think they'll even help you have an idea of how, for instance, our small fleet and owner operator summit will, of course, dive into seeing how carriers, small carriers in particular, are responding to what we cover here at the Stockout as well. And I think last but not least, speaking of small carriers, owner operators, make sure you go check out the playbook as well. Our wonderful friend Adam Wingfield is partnered up with FreightWaves to create a masterclass for you. If there's someone I'm going to learn from, it is this guy. Adam is going to teach you, of course, not just how to exist in this market today, but to scale your business and continue to grow and what you should be looking at. So we all love some Adam Wingfield education, and he's bringing that to you directly through FreightWaves as well. So thank you, Adam, for that too. And hey, it's St. Patrick's Day, drivers. So let's get all the loads delivered. Let's focus on that first, and then everyone out there, hope you enjoy the holiday. And thank you for checking out this episode. And we'll be back with you guys all next week.